Hi everyone. I've been waiting for some change in visibility before checking in. And while not a lot changed in visibility, after yesterday's Wild Wednesday, it seemed like a good time to share what we've been seeing. Yesterday, our current Fed Chairman Jerome Powell led his final FOMC meeting. The Fed funds rate now stands at 3.5 to 3.75%. And while there's a lot of talk of wanting to see that lower, it's really not that high of a Fed funds rate. What was meaningful out of yesterday is that it was the first time we've seen such dissent among the members in the final report. 4 members dissented from the final action, saying there'd be no change in rates. One of them dissented because they wanted to see easing right now. But 3 of them dissented the other way because they didn't like that the final statement used the phrase, a bias towards easing. So right now on our Federal Reserve, we have a lot of varying views on what the future might look like. At the same time yesterday, after the market closed, we heard from several of the really big tech companies, and all eyes were on their results. Meta, Google, Microsoft, and Amazon all reported revenues and profits above expectations. More than that, they all confirmed incredible levels of expected capital expenditures into ongoing growth in the AI trend. The number of investment was what most investors were looking for, and while the results were good, we're seeing mixed results this morning. During the day so far, Google stock is up tremendously, around 8% last time I checked. Meta is down the most, around 9%, and the other stocks are in the middle. Why this big disparity? Google, Amazon, Microsoft all have cloud services where their investment can immediately lead to revenues coming in to their other services. It's not as clear with Meta. Meta doesn't have that additional source of income. So there's going to be continued focus on that. Aside from these big techs that were a bellwether for this season, it's been a really great earnings season. Earnings across many sectors have come in very well. And this just confirms all of the economic trends we saw at the start of the year. This morning we heard that GDP for the first quarter came in at 2%. This was just slightly lower than some people were looking for, but it's a big reversal from fourth quarter where the report was a negative 0.5%. So all these economic trends underlying our economy are looking positive. They're on trend for what we saw at the beginning of the year. And this is all a backdrop to the other piece of news yesterday, that the UAE is going to pull out of OPEC. We don't know the effect of this. We have no insight into how long or when the conflict in the Middle East is going to end. And there's no playbook that everyone's looking to agree that the strategy is being followed in a predictable way. So we continue with this idea that we have a strong underlying economy, that we are investing with that in mind, but constantly monitoring an unpredictable global outlook. Today, U.S. West Texas intermediary crude is over $100 a share, $100 a barrel, excuse me. If this continues for an extended amount of time, we are going to see that pressure throughout our economy. Yes, we'll see it in the inflation numbers, but let's talk about everyday boots on the ground. We're going to see it in higher shipping costs. We're going to see it in that flowing through to food costs, clothing costs, raw material costs that have to come here. So the longer this goes on, there is some real pressure on an underlying economy that's still good today. This is our outlook. We'll continue to invest for the stable economy with a careful eye on what the pressures are. Reach out if we can talk to you any further about these things.